Hello, welcome to the Credit Compass, your guide to navigating the complexities of European credit markets. Each week we unpack the key developments shaping credit, explore the macroeconomic forces at play, and dive into the strategies that matter most for investors across Europe and the UK. In this week's episode, we unpack two recent surveys that provide insight into executive sentiment across the globe and at home in the UK. Global trade policy remains a central concern, and while the UK had been on a cautiously constructive path, September saw some retrenchment. Meanwhile, the UK government has chosen to lean into fiscal discipline, raising expectations for tax hikes while aiming to reassure markets on budget credibility. Let's dive in. We begin with the McKinsey Global Survey, officially titled the Economic Conditions Outlook, the September 2025 edition, conducted in late August and early September. This sentiment survey captures the views of executives from around the world. Top of mind, trade policy. For the second consecutive quarter, shifts in global trade rules were cited as the number one disruption globally, domestically, and at the company level. Executives view these changes as both a challenge and an opportunity. Notably, 15% of respondents now see trade policy shifts as a growth lever, up from 12% last quarter. However, only a third feel confident in their company's ability to navigate these shifts effectively. In response, firms are focusing on scenario planning, price adjustments, and reconfiguring supply chains, further signs that agility remains a core strategy in today's uncertain macro environment. There's a modest bright spot. Views on the global economic outlook have improved slightly. Only 43% of executives expect conditions to worsen over the next 6 months, down from 46% last quarter and more than 50% in March. That said, optimism remains limited. Just 33% expect conditions to improve. Interestingly, this stands in contrast to signals from the capital markets, which appear to be looking through those near-term challenges that executives are voicing and pricing in a more constructive, longer-term outlook. However, the picture darkens when the focus turns local. For the first time since 2020, more executives expect deterioration in their home economies than improvement, driven primarily by negative sentiment in North America and Europe. China and India, on the other hand, continue to stand out for their relative optimism. A growing concern from the survey is employment. Over half of respondents anticipated rising unemployment in their countries over the next 6 months, another level not seen since 2020. Europe was a key contributor here, with the percentage of executives expecting job losses rising from below 40% to over 50%. The upshot? Well, as we've noted in recent weeks, expectations for a meaningful return to growth in Europe continue to be deferred, so the upshot continues to be delayed. The evolving trade environment, while potentially rich with opportunity, has made long-term investment planning more difficult. While we still expect an inflection point in 2026, the road to recovery remains slow and uneven. Turning to the UK, the Lloyds Business Barometer, a monthly sentiment snapshot, echoed some of the global themes. The September survey, conducted in the first week of the month, showed a decline in overall business confidence. As we saw in the recent PMI prints, sentiment slipped across manufacturing, construction, retail, and services. In manufacturing, the temporary shutdown at Jaguar Land Rover due to a cyber attack may have contributed to the gloom. Headline confidence indicators, economic optimism, trading prospects, staffing expectations, all fell in September. From the Bank of England's perspective, there's a silver lining. Both pay growth expectations and firms' pricing intentions declined, supporting the case for easing inflation pressures. On the surface, it may sound like a deterioration across the board, but context matters. Despite the month-on-month decline, most net balances remain in positive territory and confidence is still above historical averages. Trading prospects are near all-time highs and staffing plans remain in expansionary territory. As we discussed last week, recently announced trade and investment deals, particularly those stemming from the US-UK economic dialogue, weren't captured in the September survey, but should offer support in the coming months. So, while the mood among UK businesses dipped in September, the broader tone remains cautiously optimistic. Much of the unease seems to be tied to uncertainty around geopolitical risks and domestic policy direction. Which brings us to Westminster. This week marked the Labour Party's annual conference, where Chancellor Rachel Reeves offered few surprises in her keynote. With the budget not until November, details were always going to be limited. Still, the message was clear. Fiscal discipline is the guiding principle. Labour is acutely aware of the need to avoid market instability, especially after the turmoil seen under former Prime Minister Liz Truss. Reeves reiterated the party's commitment to stability and hinted at tax rises, while Keir Starmer placed emphasis on long-term growth and execution. Difficult choices lie ahead for both, and while specifics remain scarce, the groundwork is being laid for tax increases, though framed within a broader agenda of economic renewal. So what does all this mean for credit markets? In Europe, a cautious but generally positive tone prevails. The McKinsey survey reveals regional executives as among the most pessimistic globally, expecting weaker domestic conditions and higher unemployment. Yet, as we've noted before, actual macro data is gradually turning more constructive. In the UK, the Lloyds survey paints a more mixed picture. Confidence has dipped, but remains resilient, particularly when viewed against historical norms. Regional and sectoral performance is uneven, but the overall trend hasn't collapsed. Politically, the Labour Party is emphasizing credibility and discipline, which credit markets tend to reward. Fiscal clarity combined with growth-oriented reforms would be a constructive mix for UK credit. Markets have already begun to price in this nuanced backdrop. European equity markets have moved largely sideways in recent weeks. Credit spreads widened slightly earlier, but have since stabilized. Interest rates appear to have plateaued, with little near-term pressure for dramatic change. If anything, the directional bias for short-term rates in Europe appears to be shifting higher, but not imminently. Where should credit investors be looking? Well, if you can find them, start with the 12 to 15% of firms that see opportunity in the evolving trade landscape. These are likely players in infrastructure, utilities, or firms with well-positioned supply chains. On the other hand, consumer-facing sectors and cyclical industries continue to face headwinds. That's it for this edition of the Credit Compass. If you found today's episode valuable, be sure to follow, rate, and share. And if there's a topic you'd like us to cover, drop us a line. We'd love to hear from you. For deeper research and credit ratings, visit KBRA.com. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.